So rates overall, we're still hovering near record lows. Are you worried at all, however long it takes, about rising interest rates and what it's going to do to portfolios, this idea of the bond bubble?
Yeah, I don't think there is a bond bubble.
Okay.
And most people say that there is one.
Why not?
I also don't think the rates are going to back up as aggressively as other people think. And there's really three simple reasons for that. Number one, the specter of deflation as it relates to the global economy is more fearful than any specter of inflation. Moreover, Federal Reserve would tell you that if they look at the measurements, the econometric models that they use to measure where overnight rates should be to get us to full employment and still keep the currency stable, those are negative rates. And that's the reason why they're doing all this quantitative easing. And I think that's going to happen for a while. As it relates to the bond bubble, there's about $4 trillion on the Fed's balance sheet. It's growing at about $83 billion a month. My guess is when you look at the duration of that balance sheet, it's a 7-year duration. Whether it's Janet Yellen or her successor or whoever it might be, my guess is that they'll just hold those bonds to maturity and let them roll. This way there won't be any excess supply in the markets. And so a bond bubble would be caused from the Fed making a decision to press a button and to sell those assets into the marketplace. A lot of people are saying that's going to happen. I take the other side of that. I predict that that will not happen, and we do not have a bond bubble.
It can just run off safely.
Correct.
How
Correct.
high could they get by, say, the end of 2014? You think they're going to go up more?
I do. I think
rates are going to go up slowly?
Well,
how high will we see them?
Well, let me rephrase it. I think we're going to see more purchases by the Fed.
Okay.
And I think that rates are going to surprise people on the low end. Not to say that they won't back up a little, because the expectation is that they're going to go up, and some of these things are technical and psychologically driven. But if you really look at the economic fundamentals, we're going to have lower rates than people expect for a longer period of time.
I know people say, watch out. We've been in this 30-year bond bubble,
yeah.
And now you're going to start losing money. You don't think people should be worried about that?
Well, I think they should be worried because there's other places they could put their money as it relates to getting yield, and there's other things that are more attractive. Dividend yielding stocks, as an example, are probably more attractive right now than the in general bond market. Our unemployment situation in the United States is a calamity. We're in a national unemployment crisis. The 7.1, 7.2% number doesn't really tell the full story. You have to look at the U6 unemployment number, which factors in all the part-timers and all the people that have stopped looking for work, at the lowest labor participation rate in 35 years. Our wage growth is non-existent, and our purchasing power is down about 8%. So that means that the average American who had $1 in their pocket in 2008, they now have like 92 cents. All of these things are baked into the analysis that I'm describing to you, and these are things obviously that the Fed is looking at. This is the reason why I think rates are going to be lower than people expect.